None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Friday, the end of the week, college football tomorrow. Lots going on here for sure. What a crazy week, huh? I almost wanted to do a meeting on Wednesday, but it just was just crazy how we've seen the markets gyrating back and forth. And I guess we could say, we're finally seeing the follow-through that we were hoping to see. There is virtually no news out today, which is probably good, although the market's trying to go positive as we're sitting here right now. We're down $1 in a day, and the Dow Jones is up 39. I'm not sure what the hot stocks are in there. Maybe, Mitch, when we go off, maybe you can see what the movers are in the Dow Jones. But the overall configuration is pretty negative. We have seen a breakdown, so we're going to go through all the technicals here in a minute. And lots of things going on. And while everybody thought it was about the Fed this week and the minutes that came out, which were pretty much the same, I mean, that's what they've been talking about, and the so-called dovish comments, the short covering rally that we saw was just nuts on Wednesday. And it started early on and just kept going, and there was no substance to it, and
right.
We found that out at the end of the day. Before we get going into some of these other details, Mitch, there was nothing out there today, right?
Yeah, I mean, they had the import or export news that came out. That's nothing really worth mentioning. Yesterday, jobless claims came out almost right at expectations. So, again, another non-newsworthy item there. So, really, this is market sentiment driving it. We're in earnings seasons now. So, I mean, that's the name of the game at this point.
Yeah, and I think, the markets are waiting for the so-called buy the dippers. And the buy the dippers seem to be out of town today. Maybe they'll get something going. But like I said, the Dow Jones, the only thing up. The carnage, and I'll go through this in a minute, that continues in the NASDAQ and the Russell are just going on. This thing, it's still the love affair with the large caps that are trying to come back in. We're up down 78 cents here, so we're about to go positive, down 3 cents. So we're going positive on the next tick, probably in the S&P. But in the end, there's just not a lot there. The underlying markets are still very, very weak. And there are some pretty key numbers that we reached today that I will discuss, because I think they're significant, and we're supposed to have support here. In fact, our weekly ranges are right in line with all this. So I guess with nothing else, let's just dig into the technicals, because there's just nothing else to talk about. Although, I know what I wanted to say is that it's interesting because we were expecting to be about the Fed. Well, it ended up to be about the ECB. This week ended up to be about Europe and the realities of Europe. And I think finally people are coming to grip. There are systemic issues going on in Europe, and they're not going away anytime soon. And I'll probably talk about it more on Monday when we have a better chance. but there was a guest. Usually academians, I turn the TV off when they come on, but this guy was one of the more interesting guys I've ever listened to from the standpoint. What he was talking about wasn't predicting markets. He wasn't one of the the Hussman types that, maybe Hussman's probably feeling pretty good finally. He's been bearish for...
He's finally got some traction.
Yeah, he's been bearish for 5 years, and he's finally, the market's going down. But the bottom line is he was talking about the structural issues with the euro and with the entire European experiment, I guess is the best way. It's still an experiment, and the experiment is, the beaker is like overflowing with them onto the desk right now because there's a lot of systemic issues. And one of the things that was discussed, which I think comes out, it was very interesting that night because I guess this was Wednesday after the Fed when he was on.
Yeah.
And Draghi was supposed to be talking, and he was talking about how all of the actions, there's a program called OMG and the ABS, which is the asset purchase. OMT is the to buy sovereign debt, and the ECB does not have a mandate to buy sovereign debt. And he compared it to the same thing as if the Fed were to buy California or Illinois bonds because they're both in trouble to bail them out. It just doesn't work that way. You have to. They can't buy any debt at all that's sovereign. And the Supreme Court of Germany has already ruled on this and said that it was illegal. They have passed it off to the European court. I think it's some kind of parliamentary court that they have there that oversees all of Europe. They're going to render and see if they have any opinions on it, and then it goes back to, in February, this will be decided. And then this is why Angela Merkel is the most powerful person in Europe, because she's Chancellor of Germany, and it's been the government of Germany have been very quiet other than they have pushed back on these entire programs. And here's after he said that, a couple other things he said. 3 hours later, Mario Draghi comes out and says, without some kind of reform, I can't do everything I said. And that's when you saw the world roll over. At that moment, we came in the next morning, and that's when everything turned around yesterday. We walked in the door, and it was Katie barred the door. And that is the realization that Europe can't be bailed out, that they can't do the types of things that the Federal Reserve can do. And I think Mitch and I were talking about this yesterday. I am still convinced that the Federal Reserve, in their mandate, was only to be able to buy government paper and agency. So government agency or actual government sovereign debt is all they could ever own on their balance sheet. Well, they bought mortgages, and they called them AAAs back in 2008. There was no AAA mortgages. It was like a unicorn. It doesn't exist. They just can't. They can't. It wasn't real. So I believe even our Federal Reserve has stepped way beyond its bounds and where we are today. So now they have $3.5 trillion, almost $4 trillion worth of mortgages on it. When we started the crisis, it was literally $900 million was a balance sheet on the Fed. Now, it's approaching $5 trillion, and you've got all these mortgages on there. So if they do nothing, they get out of the buying bonds program. That is now what we have is the Federal Reserve is a Ginnie Mae fund. And so all they're going to do is let these things pay down over time, and they'll ultimately get out of the market, which will take, I think the average duration is around 14 years on the mortgages they own. So 14 years from now, they'll be finally get all that junk off the balance sheet unless they figure out how to sell it to somebody else. And I don't think anybody wants it. So that's the other problem. So they have facilitated through the mortgage purchase program almost all of the sales in this country from mortgage origination would go to the FHA and other agencies, and that's how they financed everything. So I don't know what's going to happen from here when the private enterprise has to come in. But it was interesting after this guy was Hans Werner. He's a German, and after his comments, it was almost like Draghi got the memo and he said, we can't do this. It's, we need a new. As a matter of fact, he said you can't even amend. A 2/3 vote in Germany cannot even amend the Constitution. This is against the Constitution of Germany. He said it would have to be a complete referendum to change it. And he said the probabilities that it happen is next to nothing. And the Germans don't need to do anything because they're in control. So anyway, enough about that. But this is really what's changed in the market this week. It's no longer about what's going on economically here in the U.S. right now, because what we do see is a kind of a mixed picture, same picture we've been seeing for several months, and it just kind of goes on. So this is the fundamental shift, I believe, that we're seeing in the marketplace. Europe, once again, is coming to haunt us. This time, they have no bullets to shoot. They don't have anything. They can't go out and do some coordinated effort. Is the Fed, I am convinced, wants out of this game. They never wanted in it. They got in it. Now that, like I said, they've got these trillions of dollars of mortgages. What are they going to do? Expand the balance sheets at 10 billion or 10 trillion, and then our debt clock continues to click to 18, 19, 20. This is just craziness. We all know this, and we live in this fear, I think, every day. And as long as the market's willing to ignore some of the details of that, we keep going on. And there's a problem, without going into this even further, of talking about what the effects of zero interest rates are. And especially in Europe right now, that's why we see this stampede into U.S. Treasuries and all that. So let's go ahead and get into the technicals and see if we can make some sense of this on as far as the markets go. As I mentioned, this crazy volatility that we've seen back and forth over the last couple of days has been pretty insane from the standpoint. I saw the VPM rangefinder, the 3-day indicator, went to 37.58 yesterday. It looks like, based on so far today, we're going to see some contraction. We're looking at about 24 points already, so it's still been a pretty wide range, no matter how you look at it. But it seems tame compared to what we've seen over the last 2 sessions. So the realities is that the markets are trying to stabilize here. There's some key numbers I've been touting out there for a little bit. 1911, and I meant to have this up here, but 1911 was the S3. 1917 was a S3 on the monthly graph. When we put that out at the first of the month, that was the monthly graph was suggesting we could be down at 17. Here's my weekly numbers I just want to bring out. But so we have exceeded now some of the monthly numbers as far as it goes. The key number, there's a Fibonacci number at 1911. There's another number at 1904.78, which was the July lows. For me, that's the key point that we're going to need to pay attention to here. And by the way, it also happens to be the 40-week moving average is 1911. We got down to what, 1284, and not sure what happened there. 1 second here, my computer has looks like I lost you, Mitch. Anyway, so what's happened here, as far as the markets are going, we see this volatility, and we're seeing it follow through to a point. It's trying to rally right now. We're up 198 on the S&P, but the key weekly numbers have been penetrated. But 1911, which we got down to 1284 today. The 1911, I think it's 60 is the number. Below that's really the July lows, which is 1904 and change. Let's take a look at the weekly graph real quick, because I'll show you the number that's there. You'll see right here that the green line over on the side here is actually, this is that. Let me bring it up here on the screen. Sorry, I get some distractions. I got a computer blinking at me doing weird stuff. The 1907.66 is the 40-week moving average. Don't know exactly what the 200-day is. Maybe Mitch, you can Tell me what 200-day moving average is on the cash S&P. But I believe it's very, very similar in number. It should be pretty close to that. So all of these numbers, I've talked about this before, are clustering here. And I can tell you, some people are waiting for them to be broken. I'm going to tell you right now that they will be broken. And the reason why, even if there's a bounce off of these numbers right now, there's nowhere to go, because there's no material action that could happen from the economy to whatever. We're going to be, looking at earnings. And my guess is, from what I've been seeing so far, is that some of the forward-looking guidance isn't going to be positive. And that, as always, that's what the markets look at all the time, is what's the forward-looking guidance as far as expectations. And once again, think about this. Some of these forecasts and things that we're saying, they're the same as some of the other reports that we see all the time, the survey reports. Their opinions of others or feelings about how things are going to be, and in the end we find out that maybe the feelings were wrong. The bottom line is what I'm seeing here on the charts is pretty serious stuff.
The 200-day simple moving average, by the way, is 1904 at this point.
1904. So there we go. So 1904.70 is the July low. So we're sitting there right now. And the probabilities are 60% plus now that we're going to go through this number. I started to throw out some numbers. The downward targets, just off the pattern we're in right now, is for a move to 1907, which we got to 12 today, but 1897 range. That we should see that. So we should test this. And going back several weeks ago, if you recall, I said this 1904 level will be tested. We're not getting away from this without testing it. It appears now that all the momentum is drying up in this market. And if you can see right here let me move this over a little bit so you can see it. But all the PPMs, PPM 1 is 0.02, which is basically flat. PPM 2, 0.012, and PPM 3 is 0.1283, so we'll call it 0.13. So that upward bias that I talked about on Monday has dissipated even further, and every week that goes by, every new bar that we get on this chart is causing more of a decline in the momentum. And once we start to close below these levels, now we're closing under the 10-week and the 21-week, and for me, the only thing that matters, that number is 1963.32. I happened to watch last Friday's broadcast a little bit just to kind of remind myself of some of the things I was saying. And I said last week all I want is a close under 1963, 1964, I think it was last week. It was a little bit different just because of the movement here. Let's see here. Yeah, last week 1960.90. So yeah, it's still rising a little bit. But closing underneath the 10 and 21 period moving average is what's going on here. And I'm going to try to blow this up. I'm hoping this comes out, because I have spent a lot of our time talking about this phenomena that happens when the 10 converges on a 21, and when the PPM start to converge. We're looking right now at these 0.1 right now is it's just down tick a little bit, but what we're seeing is the collision course that's on the PPM 1 is still slightly up, but the PPM 2 is up at 0.12 while basically we're flat. So it's going to dissect through that 10 period moving average. And on the crossover, those are signs that only happen when these moving averages start to invert. This is the beginning phases of the inversion. If you can see this, just this red line going back to April, the line continues to stay above the 21, but it's on an absolute collision course. This is going to happen, and once this happens, this will be something different. And going back to what old Trader Vic and Vic Sperando used to always say is, expect more of the same until you see something different. Well, guess what? This is something different that's about to happen. I suspect when we come in on Monday's meeting that we will have this event on the first ticks of Monday will have occurred. So the whole bottom line is that we're seeing this all happen. So I'm going to go and zoom back out, and let's go over to the monthly graph, because this one was got me to gasp when I looked at it. I talked about PPM1 getting under. I'm going to get off screen so we can see full screen here for a second. And I talked about this happening. We are now at 0.41 on PPM1, 0.18 or 16 on PPM2, and PPM3 is now below 1% itself, and that's been staying about 1.06. It's finally starting to fade. And about an hour ago, before the show, when we were trading a little more negative, I want you to look at these numbers. Let me bring it up on, this might be better to bring it up this way. But PPM2, MM002 here is 1.16. The PPM, we're below the first derivative, which is 1.46. So we're below that. If you notice, the second derivative is 1.16, exactly where we are. A little bit ago, that when the market was down about 12 on the day, that PPM was, the actual PPM was 1.14. It was below that 1.6. When it crosses that second derivative, that is also the next sign that the complete, signals a complete, I guess, deceleration of the momentum on an intermediate basis. This is tracking the 21 period moving average, which tells me that this thing is seriously rolling over, and that it is going to start to turn negative sometime in the next probably 4 to 6 weeks. So we should see a move. I want you to look at over here in this blue cyan number. It's 1783.15. We are on a, I guess, on a mission to 1780 on this market, and that's going to happen, I suspect, over the next maybe 3 to 6 weeks. And the way this market goes, it could go there pronto. You could be, because I believe once you get the momentum, you take out the 1904, and everybody gasps at the 200-day moving average has been broken. You're then going to see those things happen. You're going to see that. You're going to see an acceleration on the downside, because now everybody will be convinced that something is happening. And a lot of folks are going, well, it hasn't broken that, and that's okay, because if that's your trigger point, then that's your trigger point, and that's part of being disciplined to whatever it is that you're doing. It just so happened, what we've seen is we've been rolling out of asset class after asset class for several months now as they've failed. And it's a different look. If you think the world operates on the S&P 500, you're wrong. It actually operates on all these different asset classes, style boxes. There have been all kinds of dislocations occurring. And in fact, we'll go through in a minute. We'll take a look at the IJRs and the Russells and the NASDAQ. And you can see, I mean, NASDAQ's still minus 35 on the day. There's nobody buying that. And whatever, did you ever find out what the movers were in the Dow Jones, Mitch?
Yeah, right now the movers are, bear with me one second, I just had that pulled up. Shoot.
Yeah,
we got me on the spot now.
Yeah, I do.
Coca-Cola is up 1.6%, Procter & Gamble up 1.5%, Pfizer up 1%, United Health Group is up 1.8%. It had been up 2 earlier. What's pulling it down today is technology. Intel has dropped 4% today. Cisco has dropped 1.96%, and GE's dropped 1.5%. So those are the biggest movers in the Dow at this point. And
if anybody's wondered if Alibaba was the top of the market, the answer is yes. That offering came up pretty much at the top at 2019. So it
is amazing.
It is, and we were talking about this yesterday. As the theme has been for a while, is all of these companies have been buying back stock. Right now, we get this just barrage of these monster deals coming to market and just sucking. I mean, think about it. There were 50 million shares to buy Alibaba. They had to have it. That was such a book cooking for the institutions, because there were only 12 institutions that got allocated stock. So 12 institutions are now they're trying to hold a bid up. I was looking at it this morning. It was finally starting to crack, and they have to hold it up for 30 days. So I don't know when the actual offering was, but they're going to play market maker until they can, and they're getting out of the stock. They're hoping a lot of people still want it, but 50 million shares paid $99 or so, and now it's 88 and change. It's down 10%, and what's going to make that go up? And the answer is nothing. And I always say pretty bad when the biggest IPOs ever was a Chinese company. It wasn't an American company, but it was just sign of the times and how appropriate that happened. But anyway, getting back on track with the technicals. Thanks, Mitch. Appreciate it.
Yep.
From the technical standpoint, looking at this stuff, this is the big chart. I know I've been beating on this thing week after week, but it's super slow-mo, and it's doing exactly what I told you guys 3 months it was going to do. Even though we bounced off a 10, we made a new high. I said, don't worry about the new highs because this thing can't hold here the way the configuration says. So that's been the right call, and now we're finally at that tipping point on this chart. And like I said, 0.42, 0.16, I'm trying to see, yeah, so it was 126, so we've dropped 10 ticks on the PPM2, and like I said, we're below 1% now on the PPM3, so everything is slowing down. The collision course is still on, it's getting even faster, so the PPM2 is going twice as fast, over twice as, almost not quite 3 times, about 2.5 times what the PPM1 is. So that collision is going to happen. They're going to cross. And if you look at this chart, the last time they crossed to the upside was way back in 2011. And they've been above the 21 ever since. And I went through this in the last show. Just real quick here, bring up a whiteboard. And I just want to point this out again because I think it's important to keep a perspective on. But just right here on this chart, I'll just use a cursor for a moment, is every time these big declines happen is we get a crossover on it starts with that 1021 crossover, and that's the confirmation. By the time that happens, we are looking at a monthly graph. We are still, and I've been saying this, 1 to 4 months out for that crossover to happen. But meanwhile, 1783 is the target zone for that moving average, and it's rising at 1% per month. So as we get closer, we're not even to the middle of this month, so we get quite a few days before we are going to see any real change in that value, and it starts ticking. But it is moving right now. It is moving at 1559. So that is pretty much the case of what's going on as far as that goes right now. So as I mentioned, once this thing breaks, we start to see it go down. We should run towards. I have a range of 1818 to 1783 is the target zone, and like I said, we're heading there. So let's go ahead and go to the intermediate chart. And take a look at that. Let's get to, when we look at the intermediate chart, this is the thing that I think is important to look at. While the momentum is starting to accelerate on PPM2 to the downside, and that's just confirming that the probabilities of this level breaking down is even greater. And we could get a minor bounce off here, but now we should stay below the 1947 level. It should not be penetrated. So that sounds like a long way, but in this market, it could be about 8 minutes if it decides to rally. And we've been hanging around this on-change level for a while, and we've seen this before from the standpoint of how the markets they'll trade around on-change. And if one of the things to watch for, we're coming pretty close right now to the European close may have happened. We've been seeing heavy selling coming out of Europe every day, and we'll go through. Matter of fact, while I've said that, let's just go ahead and look. I want you to see these international charts that I've been talking about for a while. I'm going to open up. This is S&P, spread S&P versus EFA, and you can see it's starting to turn up. It's starting to show some characteristics that it's going to turn up, and that's good. But the emerging is a much more dramatic chart here. You can see at the bottom, it's starting to flatten out here. This steep decline has been in place for a while. It's starting to flatten out, which is also the sign that we're going to start to see a turn up in this chart. And I've been talking about for a while, the U.S. market will start to go down when this shift of capital starts to happen. And like I said, this doesn't mean Europe's going to go up and we're going to go down, but it could be that there's a huge cash flow change. And as I've said, from watching CNBC Europe for a while, these guys are all talking buy the U.S., and they get the double whammo. They get the appreciation in the market, but they get the Dow, what's happening in the Dow strength is helping them out. And in the end, now that the market's starting to decline, this trade doesn't look as good, or starting to look differently. Maybe you're breaking even, or you're not going down as much because you have some Dow appreciation still going on. And boy, there's just so much we can talk about the Dow and all kinds of stuff. Mitch and I were talking about earlier, and there's a lot going on, and what the effects of this dollar rally is doing and all of that. But let's go ahead and go back and take a look at, let's go to Russell real quick. And this will be very helpful if I get on the right chart and do that. So the Russell is now up 0.5%. So we've seen a little bit of a reversal. Like I said, this thing we've got ppm2 at 0.41, 0.38 on ppm1, and 0.16, and these are minus numbers, by the way, minus 0.41. It's a huge trend. So one of the things I talked about the other day is that the 11, it was like 1109, so we got up to, high was 1106, and these averages right above, you can see that we've been writing down this 10 period moving average here in the red line, and with a 0.38 number, this is a daily graph, on a 0.38 number, there's only about a 20% probability for the market to rise above that. As long as it stays above, below, actually in this case, below 0.25, and you're in trend mode, you're going to have a difficult time getting over this line. Now what could happen is we could see some consolidation here if there's not a further breakdown, but we'll see how today pans out. All of a sudden the S&P was up flat, is now up 696 on a day, so we're seeing some of this buying coming in. And over here you can see this is the futures charts. I want to go over there and show you what's going on there. So you are seeing some cycles come in, and the market's moved up toward the highs of the session now, so at 1934. So good chance with the spike that we just saw here, right here in this hourly graph, that we probably saw the low of the session. We'll see how this thing ends up. If anybody wants to, you might see a little short covering after yesterday, but it shouldn't get too carried away. Like I said, the key number 3710 is the top end number, which is the S or R1, and above that it's literally running in 10 handles, and because of the volatility we have that 37.58 range probability. 1947 even is the next trade above that, so there's 10 handles above 1937.10, and we'll have to see if we can get above that. That's going to be pretty tough resistance, I would suspect, right there. And just kind of rewinding just for a minute, if you look at what happened with the big rally on Wednesday followed by the big sell-off yesterday, what happened was when we closed at 1928, we were only 7 points lower than we were on Tuesday. So that little blip in the middle there made yesterday felt like a big deal. Well, we've only declined. Right now we're trading the same price we were on Tuesday. So it's flatlined, even though we saw all this volatility. it's flatlined around that 35 number. And I am real keen on a close under the 1942.60 number today is a pretty negative number. So we don't have to close at the lows. We don't have to do all this stuff. And there's possibilities looking at some of these charts that we could see some moderate rebound. And like I said, we went down. We've now broken through the number. It would be nice to close under 19.25.25, which was the low of Tuesday. I don't know if that'll happen with this volatility. This rally can go away pretty quickly. We're up almost 100 points, and that's interesting because typically the S&P and the Dow Jones are a 10-to-1 ratio or close to it. So this would mean we'd be up about 8 points on the S&P for 80 points on the Dow Jones. So Dow Jones ratio is a little bit out of whack. That's why I was trying to see what were the big movers moving in there and what was pushing the market around. But this pattern is just looking at intraday level. It looks like we put a low in, just based on what we're seeing. If we can't get over the 37.10 level, we should see some retracement. We'll see how it flows. We've already backed off already at up 300 points already, just as I was trying to explain what was going on. So lots of volatility, a lot of movement here.
And Bob, I don't know if you've noticed this, but for the last few weeks, it seems like every week that we close lower, the Friday of that week, we've actually closed higher on the day. So we keep seeing this consistently as we come into the weekend. There's either short covering or just moderate rallying taking place. So Fridays have been positive, but the rest of the week has brought it to be negative. And this week we're sitting at a loss on the week of 2%. So
right.
It'll be interesting to see where we end up today.
I remember last week's show when we were talking, we were down like 1.1. We ended up like down 0.6 something, almost 0.7 on the week. So there was a rally, as you mentioned at that time. So those and this is just the patterns that continue to unfold. But in the end, we're still losing ground, and that's pretty much what's happening there. So let's take a look at, we're looking at the Russell here. Let's go to the weekly graph, because this is a daily, so we get the daily noise going on. When you see this graph, you start to see more. We have actually traded down into the Fibonacci projection numbers that we had here. Those numbers, the low target was 1077 all the way down to 1037 to 1011. The low of this pattern here has been 1055. So we have come just about into the low target 2. There's one more level below this. Typically we will come between that target 1 and 2 as a target zone. We'll get some consolidation, and then it will continue on. And like I said, looking at the weekly, the longer term averages are just starting to roll over. You're looking at 0.01 minus 0.12 on ppm 2 and 3, but when you look at ppm 1, which is based on the 10-week moving averages, minus 0.35. So it's in big time trend mode, and that is where we're looking at. That is going to be the point where it's going to bounce off. So that's 1138. It's dropping just in point values. It's dropping about 4 points a week. So 1132-ish, maybe 1131 on next week, and that number is coming down, and that's going to be your key resistance on there, and that's a long ways away. That's 50 handles plus on this. Let's take a look at the composite. We haven't looked at that one for a while. If I can type the right. So the composite is similar as in all of them, sitting right on its 40 week moving average / 200 day. And we're looking at those values right now of, all of a sudden my screen froze. There we go. We're looking at that at 4303.17 is that number. We're 43.47. 40, we're below the 21. So like I said, the high probabilities for the first time in a while, we're going to close under this 40, 10 and 21 period moving averages. The 40 is still support. It's up 0.19, so there's some little minor bias there. The extreme on the day low 42.99. So we got down to pretty close to some of this to this 40 period moving average here. We're looking at 43. We just spiked through it by just a few ticks. So we bounced off of that for the moment, and we'll see how this thing ends up playing out at the end of the day. But this is going to be a little support here just because of the 0.19 support. It's interesting because PPM2 is up 0.44, and that, while that is falling fairly quickly, that's still in a uptrend mode. So it's going to be interesting how this goes. There may be, that tells us that there could be a rally back to that number. So we could see a little minor low here. So don't, we're not in a crisis mode, by the way. We are in a reevaluation mode of the market. So this is not 2008. There aren't really systemic issues going on. What we're doing is this is a more normal market from the standpoint of how things are playing out. So you're going to see things happen most likely a little slower, and we're going to see some support. So there's likely to be some support here as I look through this. And every time I do on these shows, I don't figure this all out and tell you about it. I'm actually doing an analysis and looking at these charts with you and showing you exactly what's going on here, and try to be I guess have an educational twist to it as we're going through it. But this is a big number here as far as what we're doing on these charts. So the process has begun. The process is of declining through these averages, getting them to turn over and go forth. Let's see here. Let's take a real good quick look at some of the other markets that we usually talk about. And we're going to look at the 10-year. This, I think everybody, you'd be hard-pressed to find anyone that thought interest rates weren't going to go up this year. Well, that's not what happened. And a lot of this has been some of the actions in Europe that have caused more of this than anything that's happened here. And the Fed continues to move toward the ending the taper. I think it will end, I think, this month or early next month. And everybody's more worried about when they're going to raise rates. And I still believe that the Fed wants the market to let them go. It was interesting. I saw Fisher in an interview at some conference the other day. I think he's the New York Fed guy. I'm not sure which bank he's president of, but he was talking, and I saw something in his demeanor and how he was sitting there, like he was like a king or something, and he's like telling the peasants what was going to happen, and he was just like so matter of fact how they are in control. And I believe that control will be lost. I believe that the markets ultimately will start to, it'll go back. I've talked about this for a while too, in the last couple months, probably for sure the last 6 weeks, that the way it normally works is the Fed responds to market forces. They aren't the market. So you have this artificial market that we're dealing with right now, and I think the Fed really wants to get out. I think they want market forces to go. And one of the things we're talking about, one of the issues with these really low rates or artificial low rates, they're not market rates. And if market rates were in force right now, you'd probably have a 30-year bond probably around 5.5 to 6. This 10-year would be closer to 380, maybe 420. And then you'd have the 5-year up probably around where the 10-year is right now, 250-ish or so. And that would be a normal configuration based upon economic activity and risk and other things. So interest rates are supposed to be the measurement of the amount of risk that's being taken. That is not what's driving these markets right now. And when the risk starts to come into the realization that there are risk in the fixed income markets start to come in, then you'll see some more normalization. You'll see some of these things happen. And ultimately, with the Fed getting out of purchasing and starting to step back, they actually want the market to go on. The one thing that Fisher did say that I thought was somewhat interesting, and I thought it was funny, actually. He says, I think the market's got it, have it mostly right. This idiot, I'm sorry, thinks he is the market, and he is not. And I believe market forces will drive this thing again. But he literally said, I think the market's got it right, because he knows what's right, and the Federal Reserve knows what's right, and all these central bankers know what's right. And it's fascinating to me. I've been doing this a long time. I watched Greenspan, and Bernanke was, in his meek style, was put into a terrible situation. He came in out of the financial crisis. But Volcker, going back in those days, and I still think Arthur Miller was the worst Fed chairman ever. He's right up there with Jimmy Carter on presidents. And you know, it's just the bottom line is the Fed is not in control. As I've said before, by mid-session every day, there are trillions of dollars of paper being changed every day in hand in the fixed income market. And the Fed has a $5 trillion balance sheet. They are not the market. They can't control the market other than people are willing. It's sort of like the tooth fairy. You know, you believe in it until you don't. And they are so full of themselves, and so it's fascinating. I've never seen anything like this in my 35 years doing this. And I know one thing for sure: nobody, not the Fed, not to anybody, is bigger than the actual market, especially in the fixed income and the debt markets that have grown to levels that are unprecedented. I mean, there's so much debt. I mean, it's a joke to think of somebody with a $5 trillion account can affect the fixed income. And if you start to add up the world debt, it is crazy. There's a world, take a look at this, folks. Go and Google world debt clock, and you want to see something scary, look at that one. That you know, the U.S. $17.8 trillion is pretty big, but you go to the world and you're looking at quadrillion. I think it's 16 quadrillion. It's scary. The entire world has been leveraged at a level that is unsustainable, and I don't know how this stuff all plays out. You know, sometimes I wish I was 20 years younger, and sometimes I'm glad to be in my 60s. And I feel sorry when Mitch and the folks are going to have to deal with a lot of this stuff, and our children. So it's going to be, the world is going to change. And the one thing, going back to Hans Werner, what he said, that the only way out, there's actually no fix. I like what he said, because I've said this before. There's no fix, and the only way to fix this thing is actually do a haircut. So you actually have to cut this debt and make it go away. So it's an Etch-a-Sketch. You turn it upside down, shake it, draw new lines, start over. And to start over is very painful, because somebody has to take out that debt, or somebody has to lose that money. And the dislocation of capital that would occur trying to do haircuts makes it not doable. So we're kind of stuck in a cycle. I have no idea. I mean, I wish I could come back in 100 years and read what came out of this, because there will be major consequences of this. And it's the world has done this before with currencies, and since currency has been around. So, but when you're talking about something this big, maybe we can print enough money to make it all go away, but it won't go away as long as you have zero rates. There's an incentive to borrow money at low rates, and it's not going to be until we stop borrowing money and we start doing things different. We charge appropriate number for the interest that's out there. That what is the risk, and it's different. If I borrow money at 1%, I'm going to act different if I borrow 6%. I'm going to be very diligent about my 6% money, because it's costing me a lot to be able to do this. And when I get into 1% money, it's sort of like, well, it's kind of free money, and a little more, you know, this different choices are being made. And you know, so it's a very, very significant thing that's going on here. And when if the Fed gets out of the way, these rates will go up, regardless of what market conditions are. They're mispriced right now, because they're being artificially held down by market sentiment in the tooth fairy, that they believe that this will continue on. And then ultimately, when you get to be 6 years old and find out that there is no tooth fairy, you start to look at the world differently. So, and that's what I believe will happen here. So, sorry about the tooth fairy analogy. But anyway, So these yields, this is the weekly yields. They're down. I talked about this the other day. They could go to 220, but I think they're about peaking out. What I want to look at is this big trade that's going on. I want to bring up the Dow. Here's another move in the Dow, up another 1/3% today. Let me get off the screen so I can show this to you. And this chart here, it is really interesting. We're starting to see the beginning phases of how this thing looks, as far as, you know, as far as the rally goes and where it's likely to end up. And the results is that we've got this move to this 85 level. And there's currently, we've exceeded all the Fibonacci levels on the expectations right now. That was around 83. Now we're at 87. We're getting fairly frothy. But if we look at the monthly graph, this is the big picture. And I'm gonna scale this back so you can get a little better picture. I want you to look at where the Dow was in 2000. This index was at 107. We're now at 85, and we're looking at the potential. If we get above these highs right here, we're looking at a potential for about a 15 to 20% gain. And one of the effects of having the U.S. dollar going up, this is going to screw up the Fed bad, because what they want is a 2% inflation. When the dollar's going up like this, what is it doing? It's making us less competitive. Our prices are not going to go higher, because we're going to have to lower our price to stay competitive in some items, especially on exports. And but the whole point is that you're seeing on the PPMs 0.65, 0.36, and 0.35 PPM 1, 2, and 3 on a monthly basis. This thing's full out bull market right now. So do not get in the way of this market for sure. And I don't know, and I would believe at some point that there's a combination of things. Some of these things that are starting to show up in Europe, as well as as this dollar movement in because of the interest rate differential right now. So it's going to be hard to figure out where this one ends, and that's the way bull markets are. These things go and they keep going. But the numbers that we're seeing, this looks to me to be the very beginning phases. If I zoom out just a little bit here, the very beginning phases of this rally. Now that we've seen this picture before, and let me bring up on the screen here so you can see these numbers a little easier. This rally ended at, the high was 89. This one was 88, and now we are 86.75. So we are back in the same range that we've gotten up to the Dow, and it's failed. Several years ago, those of you who've been around for a while know that I was talking about that I was looking for this big rally in the market to happen, but I was looking at it to be associated with a higher Dow, because you can't always discount your currency to get your markets to go up. And now we've got this higher Dow, but it's inverse what's happening. It actually is still, there's kind of been an inverse relationship. While the market was declining all over here, let me get this chart out of here. So as the Dow was declining from 02 to 06, we were moving our way to our first time to 1500 after the big recovery. And now we've seen just this flat period, elongated flat period since 2000, really 2008 lows. We have just been in this flat area, and we've been up. It's really been a range-bound situation where we've been down to around 72 on index, and we're now 89 high, and we're back at 85, 80 at the moment. And this has been the pattern. If it breaks out of this pattern, then we easily could go into the 90 range. Some of these Fibonacci projections here are looking for a move to 90 to 97. That's a very possibility, and even some of these older patterns that are recognized will be interesting to see if we get any Fibonacci patterns that jump out of here and get a more accurate estimation of where these things are going to go from a pattern expectation. And then they usually tend to go further and exceed those numbers over time. So those are things that we continue to go. Man, this has been a fun show. 5 minutes to go, really. But there's just a lot going on here. And let's go back. I had no idea that I had went on and on. We had a couple things we wanted to show you, which I've completely ran over that. Mitch, you gotta pull me off the ledge sometimes. I get going.
You were on a stream, so I figured we could just push it off to Monday, because
yeah.
I think we'll have quite a bit to talk about anyway on Monday. So.
Yeah. So let's talk real quick about. Matter of fact, I'll bring Mitch and I back up because we'll have a little conversation about this. Let's talk real quick about what VPM database. This week down 2%. We're likely to see more liquidation. Yeah. And I keep going towards this 22 to 29. We're at 29% bullish right now. We're going to see that decline. We saw most of the activity in funds that most of you don't own really, which are these allocation funds or these target date. Excuse me. And those things aren't really widely held, but we're continuing to see this deterioration. What I'm looking at is, are we going to get a bid? Is this bid good enough to trigger some buys in some of the taxable bonds that we're seeing? And some of those, that's my interest, I guess, in the run this week. And that's pretty much what I think has been happening as far as, that's the only market that's moving in a positive direction that's likely to do anything.
Yeah, I think you're right on that. This week it will be key to watch the taxable bond funds as well as the U.S. equity funds. Obviously not for any new buys, but for the sells to see if we finally start to see some mass liquidation in the large cap space. If you look at the dashboard right now on the fund side, you see that we already took a lot of protection on Monday, nicely timed, of course, in the large value and the large blend space. We did see some selling in large growth as well, about 8%. But we still are about 55% invested in large growth at this point. That may change after this weekend.
Right. Yeah, and so expectations for the markets as we come in this week with this close, unless we get some gigando rally, which in the way we've been trading the last 3 days, you never know. But that 1942 number is the key number that I'm looking for. 1942.60. Below that today is all I need. I'm happy with that. And if it gets above that, it's still negative, but it would be much better from a technical standpoint under that level. Anything under that level is all the trigger that we need to continue this weekly onslaught that we've been seeing and see it going down. So we end up 0.7-ish or so last week, I think it was. This week, we'll see how it ends up, but we're probably going to be 1.5% at least, even if there was a rally. I think we're still hanging around the 2% number. Is that about where we are, roughly? Yeah, I've lost sound here on Mitch for some reason.
Oh, sorry, that was my bad on that one.
Oh, yeah.
So on the week, we are down 2.25 at this point. So we're down still pretty substantially, even after the little bit of rally that we've seen so far today.
Yeah, so 1.75%. And folks, this is like I said, just in closing here, this is a pretty orderly sell-off, even though the last couple of days maybe has your head spinning. Like I said, we are, really only. Right now we're up 163, so we kind of failed up at that 36 level, which was that big resistance number, and we're starting to decline now. I can see quite a bit of selling coming in on the futures, but the bottom line is that the way that this thing is trading is very orderly. So you really don't want these collapses. Mitch is always hoping for it to go down like 25% in one day or something.
I did not say that. I've never said that. I might appreciate it.
Well, we've got a lot of cash on, so we enjoy the downside more than the upside days, but that's the way that goes. But but you don't want this thing to be climactic in nature. This is what we want as VPMers. We want this market to get reset so the valuations get better, and ultimately what you do is get so we can buy value again. Value needs to come back in play. So the way the markets rotate, they go from deep value 2009 to growth to overpriced and then move back to a value window again. And you want value stocks. You want to buy value stocks, and they turn into growth stocks. That's the bottom line. So anyway, we are done for the week. It's off to a USC game for me tomorrow down in Tucson, and enjoying the weekend and all that. But I am anxious to see what comes out of our database this week. And so we once again appreciate all of you. That we know we have a lot of regulars on the show, and we appreciate everybody. And those of you that have maybe first time being on, we welcome you, and hopefully you come back on Monday to watch us some more. So have a great weekend. We shall talk to you soon.